People are paying thousands of dollars for this 1-minute trading strategy, and I'm going to give it for you for free. And it's even better because the money management is better what you will find online. You're seeing here a student how he had 5 winning trades of $2,350 in total and 4 losing trades of $400 minus. You see how the trader was traded. It says he traded, made $500 and lost here $100. Made here $600 and lost $100. So as you're seeing, the money management is very good, and I'm going to give you here the full trading strategy. So take something to write, watch this video over and over again, that you can use it for your own. And here you can see another student result with 3 winning trades and 4 losing trades, and still making here $956 in winning, $400 of losing, still makes here $568 a single trade, and loses here within a trade just $100 on average. So money management is key. It's something what is very, very, very important. So make sure you have the chart, that you make it as small as you can on a 2-day perspective. So you can see the 24 and the 23 of February, and that you use the 1-minute chart. The main reason is because of the money management, what you'll see later. The most important thing is just that you take a picture in the beginning, and then you do take a picture in the end after your trading time. That means you take a picture in the beginning, you're just drawing in using your drawing tool where you see the market is going at. So in this case, you see it's consolidating here, wiggling around. Just assume it does the same thing as the past. Take a picture of it, and then just do a picture in the end. If you do this, you will see if you can see that the market is pushing out up, or is it pushing lower, right? Here the trader was assuming the market is pushing lower based on this drawing, then it was pushing up. And here you can see now, by the way, a trend means that the market is running in one direction for a longer time. So that means if you see there's a red and a green candle, this is just a low. And there's a green and a red candle, it's just a high. It's just neutral. It has nothing to say that it was the lowest or a highest point within a specific time area. In this case, because it's a 1-minute chart, we're talking about just 2 minutes or like 30 minutes or 1 hour. Highest point was here, lowest point was there at the time. And then important is if you see red, green from left to right shifting upwards, those are higher lows. And if you see a higher low, higher low, higher low, this is an uptrend. This shows you that the market would like maybe to go towards the next target where the market was trading a lot, to the next consolidation phase or bigger structure high. And this is where you see how the trader adjusted here $100 to make $500 here, just within a single trade. And once the market reached the target, you see how the trader tries to trade again. You see how momentum is off here, how the market is not making it. The main reason is that every time you see that the market is reaching a high or low, this is when the market is breaking. It's just slowing down, and this is when you just don't want to trade it much because the market just reached a target. So that means here also, if you want to trade up towards the green lines, it's good, but not trading exactly where those green lines are, the highs, because this is where the market is breaking off momentum. We need momentum to make money, to buy or sell. And when seeing the market going down, then we can sell. Here you can see how the market was going up to the green line, was trying it 1-2 times, couldn't make it. And then here now you're seeing how the trader is trading here 1 time down, 2 times down, right? The main reason is that this white line, what you see here, is the daily VWAP. And important here is that you can see how the trader adjusted here $100 just by entering the trade, just by entering here after the red candle closes. On the right side, there's a timer. And when adjusting $100 from entry to stop placement, this length is $100. If the market does this length against us, losing $100, but every same length is here $100, $200, $300, $400, $500, $600, $700, and making money just because the market went here to the small consolidation phase, right? If you see that the market is sort of in a consolidation phase, that means like this, and has here this low, and here's the small consolidation phase, just like very tiny. The market will not, when it does higher lows, reach this low because it shows us it goes here higher in structure. This is the main reason why exiting here is very important, like where this consolidation phase is or beforehand, or taking this low in the middle in consideration because that's a red and a green candle. Those are just very important key points. Let's go to another day. We have here the first one. We have here the second one. That means number 1, number 2. Number 1, you can see how the trader was making the drawing that it should go down until this low here is very realistic. And you can see how the market reached here, not even this low. You can see how the trader used the indicator that is called the anchored VWAP. The anchored VWAP is the volume weighted average price. We can place it starting this high very often the market retraces and touches it, and then off that, because the market did this move, the market will do around the same move again. But keep in mind, if this move is that long, if here's already our target where the market has nothing under us anymore that much, like significant what we can see, because it's just like maybe very old or very distant, then the problem is the market may not do the same length anymore. But you can see that the market still did a down move. So it confirmed, taking a picture in the beginning, comparing to the past hour, seeing the market does still the move in the same direction. And here you can see then how the trader, when adjusting here $100 from here to here, color switch, that for until here, it's $600 in making money, right? The trader also tries to trade down here, but the more later you trade, the harder it gets, what is just very important. Again, picture in the beginning, the low here is more near than the high. So assuming it goes down here and then just like stays here in this area. And then once it breaks out here, you can see how it consolidates. It's very important not to trade here at all. Here you can see now it breaks out, touches this high here, and then now it makes more sense to assume that it continues touching here those highs here, the green lines. And this is the main reason why you're seeing here now how the market is in this consolidation phase. Breaking out, takes this high, and it's like a domino effect that it makes no sense that it goes towards these highs instead of this low here or this low here or back to the consolidation phase. Why? Because the market is very often like a domino effect. Either takes out highs, higher highs and higher lows like this, or lower lows and lower highs. And in this case, you can see here red, green to red, green is a higher low. And now with entry to stop placement from the distance, adjusting $100, this is a $700 winning trade. So how can you start for you as a beginner? Open TradingView, make sure you take the ES1 exclamation mark, 9 a.m. Central Time to like 3 or 4 p.m. You take your 1 or 2 hours in the middle in routine, and you do the following thing. You do take the square, you find it here on the left side. And what you do here, you put the square here from here on the bottom right side. You have, by the way, the time zone. You put New York or like Central Time, for example, -4, -5, -6. And then from here on, from 9 a.m. to 4 p.m, very important. You just do, I'm just making one example now at 6:24 a.m. So that means like from 6:24 to 7:24, you're making an hour forward. You're sort of comparing the past hour, what movement the market did. I think a path tool here on the left side is very good to use, because if you draw in past movement, this is what we can also expect. There's an indicator that's called the average true range, ATR. What some traders use, it is not needed fully. And why? Because it is about an indicator that shows us like when the market is fast, when the market is slow versus here, right? So that means like here in this case, you see how the market has the realistic path that the market can go towards like this low here in this case, but not towards this low here, right? If you just look at the length. The market has a realistic path to go up here, maybe towards this high here. So these are the two targets. And then make sure you are now in a 2-day perspective, the 27th and the 2nd, for example, like this. You take a picture like this. And then just take a picture in the end and make sure this square here is your trading time, that you take a picture in the end, just to compare as you saw it, that you see what the market is actually doing. I get very often the question, what about trading another market? The S&P 500 is one of the biggest markets. We're talking about like a Euro US dollar, a gold, silver, they're like 4 billion, 7 billion a day, every day in and out. And a Euro US dollar is like 37 to 100. But the S&P 500 has 300 to 400 billion dollars every day going in and out. It's running for multiple hours, just straight in one direction. Has more signals to adjust $100 to get $500 out. What you also see in those Excel sheets. And this is the main reason why this is so important to do exactly like that, because it's the most efficient thing currently, from my opinion, to day trade 1 or 2 hours in a routine. I hope this video helps you out. Wish you all love, good trades. JT out.